Welcome back. Canadian oil and gas is a major talking point amid the tariffs from the United States. Let's bring in an expert to talk about it. Rebecca Babin is senior energy trader at CIBC Private Wealth. She joins us now from New York. Rebecca, great to have you with us. The price of crude oil has tracked sharply down since the middle of January. Has the oil market been pricing in tariffs, or has it been essentially looking past these events and focusing on other elements of the oil market?
Yeah, so I think the move over the last month has been two things. One, slight mitigation of the supply side risks that were a big part of the conversation in early January, whether that was maximum pressure on Iran or increased sanctions on Russia, potentially causing supply disruptions. We've had a couple of things kind of move in the direction of some of those supply risks are slightly less present now than they were at the start of the year. And then on the other side of that, as supply risks are kind of getting mitigated, the demand risks have been amplified through the tariff regime that we're starting to see play out. And I think that side is what's really accelerated the move over the last kind of 30 days of kind of a 7-8% move lower, as we worry less about supply and we think more about how do tariffs play out, what do they mean for demand overall for the global economy. And I think the big thing that's happened is we've started to reprice what the downside looks like in WTI, and part of that also in Brent is part of that is because OPEC, which had been standing on the sidelines, kind of keeping production increases delayed, changed their tune and decided to start unwinding their production cuts as of April 1st. So there was this support in the market where OPEC was kind of there, and now that's been kind of taken off the table. So if you were thought 65 was downside in TI, 70 in Brent, you might be looking closer to 60 as your downside scenario, and that is a bad case scenario, but that's where your downside tail looks like now, as opposed to 65 in TI. So that shift in mentality has come from tariffs, it's come from supply side risks being mitigated, and it's come from a change from OPEC plus.
In other words, I hear you saying when the market worries about tariffs, what it's really ultimately worrying about is a slowdown in economic growth in globally or in key markets, and therefore less demand for crude oil.
Absolutely. That's exactly how it translates. And I think the market is really still trying to get its head around, how long will these tariffs be in place? Can they be negotiated away? And we don't have a lot of clarity on that. But in the crude market, the demand fears tend to get priced pretty quickly because we've seen these really dramatic drawdowns in the commodity when demand falters. So there's just not a lot of risk threshold to say, you know what, I'm going to buy this dip. You may have been willing to buy this dip in January when you thought, well, we still have pressure on Iran. That supply is going to be off the market. OPEC Plus is on the sidelines. So there's those supply levers that could still kind of support the commodity. But as those have dissipated and you're worrying about demand, it becomes a lot harder to kind of step in and feel confident that you're going to see the upside and the risk reward really makes sense in the commodity.
It's been very common for people to predict since late November, when Donald Trump first posted on social media that his plan was to impose 25% tariffs on Canada. It's been very common to hear people predict that in terms of energy, this will translate directly into higher gasoline prices in the United States, which is something no president, no U.S. Political leader wants to see. But you seem to think otherwise. You seem to think that U.S. consumers will only bear a portion of the higher cost of crude oil driven by tariffs.
Yes, so they will bear some of it, but the primary kind of blow is going to be dealt to the Canadian producers, right? And that's really because there's no real other outlet for the heavy WCS crude to go. You can send some of it through the pipelines to Asia, but there's really no other way. There's no other way to move your crude outside of Canada. So what you're going to do, and we've already seen this play out to a large extent, WCS, Canadian crude, gets discounted to WTI. If we put on these tariffs, it's around a $15 to $16 discount to WTI. When there's no tariffs, that discount is closer to 10 to 12, right? So the market's already priced in the fact that they're going to kind of take the brunt of this, take the lower price and get the crude into the US. And then again, it's not going to be the entirety of the tariff. Some of the refiners in the US will bear some of that cost as well. And then the smaller portion will go to the US consumer. It's not that we don't bear some of it. It's just the primary kind of blow seems to be more heavily kind of to the Canadian producer.
One thing we haven't spoken about yet, we've spoken about tariffs, we've spoken about OPEC plus, we haven't spoken about Iran yet. How much of a wild card is that?
That's a big wild card. I mean, if we think about how Trump campaigned and this idea of maximum pressure, most traders and analysts have penciled in, anywhere between 500,000 and 700,000 barrels of Iranian supply being removed from the market over the course of the year. We continue to see these headlines that indicate that Trump is really wanting to kind of start the negotiations with Iran. And I think it's difficult to really parse through how much of this is just posturing and how much is real, because reaching a deal there would be extremely difficult. But the fact that the maximum pressure kind of rhetoric has been toned down to a certain extent, and we might not see those barrels come off the market, is certainly one of the reasons that the upside in crude just doesn't look as extreme as it did when we started the year. It's very tough to call that one. And I would say most analysts would say they think a deal is pretty unlikely. But if the rhetoric stays kind of in this, we want to get them to the negotiating table, and he doesn't deploy maximum pressure, you've still got those 1.5 million barrels of Iranian crude flowing to China, right? So that's a big headwind for the market, and it's something we're watching closely. I'll be curious to see how it plays out. My sense is I think we start to see maybe maximum pressure having to be deployed once negotiations kind of stall, but that would be in the second half of the year.
Rebecca, thank you so much for joining us today. Rebecca Babin is Senior Energy Trader at CIBC Private Wealth.